In investing and trading, we are just going to see in depth about this because without knowing this you cannot sustain for longer term. So we can go little deeper. What is an investment? Investment is nothing but you're just going to hold something for longer term with the fundamentals. What is trading? Trading is nothing but you're just going to use a technical analysis to predict the short term momentum and making money. So these are all the two difference. So let's go deeper. If you see investment, the time horizon will be like 5 to maximum of 30 plus years. So you're just going to buy a stock by seeing the fundamentals, and you're just going to hold for 5 or 30 years, and you're just going to see a massive compound. So that's what entirely you're going to do. But trading is not like that. From seconds to months, you're just going to make multiple trades to book a profit. So this is the difference between that on the time horizon. And primary objectives is nothing but investment is a wealth building. Again, I'm saying investment is a wealth building, and trading is short term profit generating. Like for example, a lot of people are thinking if you trade you can be rich, but if you ask me, only investment will make you rich. Even if you see the Warren Buffett or big traders, after one point of time they just use their money to invest. With that investment they just build a big wealth in a long term. That's what everyone have done. But in trading it's not like that. If small mistake happen, your entire capital will get vanished. So you should be very very careful. For analyzing type, for trade, like for investment, for investing, you're just going to use fundamentals like earning, valuation, the company growth and everything. But in investment, like in trading, you're just going to follow chart patterns, momentums, candle identification, like that. You are going to use these methods. And transaction frequency is going to be very low in investment because you're just going to buy rarely, like once in a while you're just going to buy, or you're going to accumulate and you're going to hold for longer term. But in trading it's not like that. Your frequency of transaction is going to be very high. You're just going to trade multiple times in a day or a week or a month or a year. So it's not going to be same like the investment. And the capital required for investment would be almost uh, from $1 you can buy a fraction of share till 1,000 or 2,000 or anything. But in trading it's not like that. You should have a huge capital to make a huge profit. So for that you're just going to risk with taking a more leverage, and you're just going to do a lot and lot of chasing against the market. So this is the difference you're just going to do. So you need to be more and more careful in this part. And the typical return target would be, if you go with the investment, you are going to aim for 8 to 12% on year. And in trading most don't beat the market. That's what the exact thing is happening. Everyone are like thinking in trading you can make a huge profit if you don't have the proper plan and proper strategy. Like even in the the research are saying 99% peoples are losing money inside the market, only 1% is making. So that's how it's happening, because trading will be like you will lose money in one point of time, but investment you never lose. Like you never lose in the sense, if you put in the right time, or like if you're not putting everything in a one basket, and if you're like properly making your portfolio in a right way, no one can beat you. So that's the exact thing is happened in the investment side. And the tax treatment would be like you are going to pay the long term capital gain tax, and in trading you're going to pay like short term capital gain tax. And brokerage cost would be very low in investment because you're just going to buy or sell once in a while. But your sometimes your commission would be more than your profit you just made when you're doing trading. Like you would be noticing a lot of time, suddenly after opening the shit you would be in a minus, but you would be in profit in the trading and everything. Because of tax and other charges and brokerage fees, you're going to be in a loss because of these scenarios. And the time required going to be you're just going to invest hours or maximum a day in a year if you're going with an investment. But if you're going with trading, you're going to spend hours and hours per day. You need to sit inside, you need to analyze, you need to take entry. So a lot of things are there. The knowledge required for investment is going to be fundamental valuation, and being patient is very important to train your psychology to wait for longer time. But in trading, you need to be more and more greater in technical analysis, proper in risk management, and proper in your psychology, because that's the only thing drained a lot of people's wallet. Because of greediness, they just lose everything in their life. So always you should be train yourself to be patient and proper train your mindset. And emotional like for example, a lot of people, I'm just saying, when they are doing trading, they just emotionally tying inside. You should not do that. Keep your stop loss, keep your TP, anything hits, come out. If you're like in trading, a lot of people are losing money because they're emotionally demanded and emotionally connected with the market. So in investment, it's very very low to medium, but in trading, you're emotionally connected towards the market is very high. So always be careful. Leverage use is going to be rare in investment, but in trading you're going to take huge exposure, and sometimes a small mistake happens, it will get liquidated very easily. So be careful. And short selling you will be doing a rare in uh, like for example, in if you take a long term investment, short selling you would use only to ensure your portfolio. You won't use in frequent way. For only insurance, you're just going to use short selling, or for hedging you're going to use short selling. But in trading, you're going to use short selling in a normal way. It's going to be very common for you. And tools used is going to be annual report, ETFs report, index funds, valuation model. These things are going to be helpful for investment. But in trading, you're going to use charts, screeners, order books, news feeds, and each and everything. So suitable for most people, especially beginners and especially busy professional. For you people, investment is better. If someone is more experienced in training themselves for trading and emotionally disciplined and dedicated, these people can do trading. And success rate, that this is the main point. The success rate, if you see in investment, it's high for disciplined peoples, and it's high if you hold for longer term, if you go with investment. But if you go with trading, the success rate is very very low. Again, I'm saying the success rate is very very low in investment, like in trading, because if you make a small mistake, you are going to lose a lot of money. And as of now, 99% retailers are losing their money because of trading. So be careful. And primary risk is going to be market downturns. You're just going to be making loss only if the market is going more against you in the downtrend, because you're just going to buy and sell it high in a investment. But in in your trading journey, time error, emotional decisions, leverage losses, so these are all going to be more and more impact for your portfolio. If you don't know what is liquidation and what are all the liquidation levels for based on the leverage you're going to take, you're going to lose a lot of money in trading. So always be careful by taking leverage, by being disciplined with your TP and SL, by properly managing your time and each and everything. Okay, so these are all the things you need to go through. And this is the difference. And now we are just going to see a little bit extra details. Types of traders, scalpers who is going to be extremely, find out small profit inside the market, and they're just going to be a little aggressive towards the market. And next one is the day trader. like you know they will take daily, they will take some trades inside the market, even their risk is also very high. And swing trader, the risk is very high, because they are just going to hold it for 2 to 10 days, and sometimes even overnight they will be buying and selling it. And momentum traders and optional traders also very high. And algorithmic traders, now only our part is coming. Algorithmic traders, like it depends. The risk is, like here I just given the risk profile. The risk is a difference based on the strategy of designing inside. Again, I'm saying, as a human being, you're going to be totally emotionally connected with the market if you use the money. But algorithm never do that. They won't emotionally connected with the market. They will be silent. They will be working on with what they need. They will be patient. They will know what exactly they want to do. They won't be hurried to make profit by seeing the red candle or green candle. So That's what the algorithm. And the new traders are like, they are the very, 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 very much losing money because they just depend total on news and what others are saying. So these are all the types of traders. So now we can see types of investors. See, passive index investors are they who is going to be focused on only ETFs, only focus on index funds, and only going to focus on index, and they're just going to hold it for 10 to 40 years. These peoples are very, very low to lose their money. And value investors are going to be focused on buying undervalued companies with below the intrinsic value, wait for the like if they recognize these criteria with the fair place value and with the proper fundamentals, they are going to buy it. They are going to hold for 3 to 15 years maximum, and they're just going to make wealth on that. And growth investors, they will buy companies with above average earning and revenue growth. And next one is a dividend investor. Their focus is only like a dividend, like they will focus on dividend yield based stocks, and they are going to hold for 5 to 10 years, and they will get the benefit from the dividend each and every quarters, or each and every half-yearly, or each and every annual. So it's based on the stock, because there is no guarantee that each and every company is going to give dividend each and every quarterly. So that depends on the on the company and on the what we choose. And next one is JRP investor, which is like growth at a reasonable price, combined growth and value, where they're just going to focus on mid cap growth and mid cap stocks, and they're going to hold for shorter time period to make a nice profit. And next one is like income investors and all, they are going to use bonds and everything. And next one, ESG and continuing investors are like, they all like normal investors like what we have seen above. So let's go a little deeper about the risk returns. And if you see in like investment and trading, the annual returns you can expect of 8 to 12 percentage. But in trading, most of the retailer balance would be negative, most, because if you're sitting inside the market and if you're doing, it would be more and more riskier for you. And maximum drawdown risk would be 20 to 50% in investment. But individual investors lose their 100% money on the leverage. I've seen a lot of people have done this. If you're sitting inside and if you're doing manually, if you're doing something, then there is a lot of chance and risk to lose everything inside the market. So that's what a lot of people are doing. And compounding effect is very, very strong. Each and every 10 to 30 years, your money will get doubled in when you go to the investment side. But in trading side, transaction cost and loss are compounded negatively way. Like most of the time you can see they would end up in the loss if you see the 10 years of balance sheet. And the tax efficient would be very high for traders, and very low for investors. If you go through deeper, you will know. And the cost impact would be low cost if you use the index funds, because they are just going to charge only little amount of fees if you go with index funds. But if you go as a trader, your fees are going to be very high than what you think. And emotionally volatile would be very low in investment and very high in trading. And skill required would be like moderate, like basic skill is very, very required, like very, very, very normal and very, very important if you are going with investment. But if you go with the trading, you should be little advanced with whatever you are going. And time commitment would be hour per year, like you're just going to spend only hours, you're not going to spend each and every hour in every day. And now we are just going to see the tools and investment on the next video. I think till now the video would be clear for you. Let's see on the next video. Bye.